Hello, my name is Alma Robinson, and I am the Executive Director of California Lawyers for the Arts. CLA is a statewide nonprofit organization that was founded in 1974 to serve artists and arts organizations of all disciplines with advocacy as well as services that provide support with legal and business issues. With staffed offices in San Francisco, Berkeley, Sacramento, Los Angeles, and San Diego, we provide several core services. First, we provide legal counseling to specialized attorneys who provide assistance with a variety of intellectual property questions, as well as contract reviews and negotiations, and other important business issues. Depending on the client's financial status, legal assistance may be available on a pro bono or reduced fee basis. We also provide a specialized program that assists independent inventors and small startups with their patent applications. To help with situations involving disputes, we provide a range of alternative services, including negotiations counseling, mediation, and arbitration that can avoid the expense and hassle of going to court. Finally, we offer a full menu of educational programs that include workshops, symposia, and conferences on various legal topics for artists and arts organizations. Many of these programs are posted on our YouTube channel, and we encourage you to use these tools to educate yourself on the legal issues before you reach out for specialized assistance from our organization. Thank you for joining today's program, and please consider joining CLA on our website at www.calawyersforthearts.org so that we can continue to maintain our full range of services. Thank you.
And now I'm going to introduce Jeff Thompson is our EA. He has been a wonderful asset to CLA and has led a lot of tax workshops for us over the last year. We're so grateful to have him here once again today. So Jeff, whenever you're ready, feel free to start telling all these wonderful people about their taxes.
Woo! So thank you all for giving me this opportunity to take a break from doing taxes to talk about taxes. That is my life for the rest of, I guess, eternity, I'm assuming. So, let's see, just in case you're wondering what an EA is what's called an enrolled agent. My licensure comes from the IRS. I had to take a 3-part test on taxation. I had to learn about how to properly depreciate a cow, if you need to depreciate that cow. So my specialization is in taxation, not in general accounting. So there's like this weird war between CPAs and EAs. We all do the same thing most of the time. Wait a second, Jeff. What happened? Your lighting is different. You're wearing a different shirt. Your hair is longer. You're unshaven and you look more stressed. Well, since I did that lecture, there are a few changes that happened in the tax law, so I have to give some updates so that you have the most up-to-date tax information. So you might see me pop in and give a little update on some of those things that I thought were going to be forever, but actually were not. Okay, cut. So it's okay for me to just cry because we're not recording? Because this has been really emotional. Oh, it's still recording. Okay, so if you gather nothing from the variety of tax topics that I discussed today, I have 5 rules where you can pay attention to those things and then just tune out for the rest of this workshop. Hopefully you won't do that, but here's some things to start. So 1, I just want to say that there are a lot of very shady tax preparers out there in the world, and they are happy to take your money and overpromise. So make sure to avoid people who guarantee that they're going to be able to get you a tax refund. There is no way to guarantee that there is a way of doing it. It's called fraud. So there's no way to guarantee that somebody is going to get a refund if you haven't looked at their documents. So if you call somebody and they say, without knowing anything about your tax situation, I can get you X amount of dollars at least, they are a fraud. So avoid people who guarantee. In the same way, that your doctor isn't going to guarantee that they can treat you before they see what's going on, whether it's like a weird thing on your skin or whatever it is. In the same way that no mechanic is going to guarantee that they can fix your car before actually looking at it, I have to look at your documents before I know what your tax situation is. Also, check your expectations. Just because your friend got a $3,000 refund doesn't mean that you will. There are so many things, as we'll talk about, that go into the refund process, where most of the time people who are getting a refund just are paying too much tax during the year, right? So even though a lot of times we might judge a tax professional based off of how big of a refund that we get, but sometimes somebody doing their job correctly, you're still going to owe $3,000. And I definitely run into this a lot where people are like, "You're bad at your job." And I'm like, "No, I'm very good at my job. So this is just what you owe." And sometimes I have to give people bad news. So I know we all love getting a huge refund. I got one this year. The only reason why I got one this year is because I paid too much in my taxes during the year, right? Also, make sure as much as you can to do your own research. Anything that I say during this workshop, you should be able to find somebody else saying in either an IRS publication, which should be one of the main places that you look for these tidbits of information, or in an article published by another tax professional, right? There is a rule that I believe in, which is the too good to be true rule, which is if you read something or if you see tax advice on TikTok and you're like, "That seems too good to be true," it probably is. So definitely be careful about people who give tax advice that, yes, your cow has doubled in value because of, this new hot tax law. So also it's important to know your limits as an individual. I have to do a required 24 hours of continuing education every year, and that is on top of all the articles that I'm reading. So I'm spending a lot of my time researching taxes just to make sure that I can answer all my clients' questions. You are not a tax person, so you're probably not doing in your life, you will not get to the same level of like having read publications until your eyes have bled that I have gotten to. So know that there are certain things where you might need like another set of eyes. Not everybody is going to need a tax person all the time, but it's important to find somebody that you trust who isn't condescending, that occasionally if you have a tax question, even if they're not doing your tax returns, you feel comfortable reaching out to them. In the same way that you have a doctor and a mechanic, maybe as you build your life, you should have people who you can rely on, but make sure that they're not like just your friend who like read a Motley Fool article once about taxes. Actual professionals, hopefully. So also a lot of people feel guilty about taxes. So just realize that like everybody messes up, everybody gets behind, everybody gets W-2s and 1099s and W-4s and W-9s confused. But all we can do is learn from our mistakes and be better next year, right? 10 years ago, I knew nothing about taxes. Now I know a lot about taxes. And I just improve every year. So if I have to improve, you can also improve. And then be timely. The IRS, the Franchise Tax Board, all of the various tax bodies that you'll have to deal with are scary, but they're not scary. They seem scary, but they're not scary. Even after doing this I feel like I've been doing this for like 7 years now. When I get a letter from the IRS, I still have like a panic attack where it's like, "Oh no. Oh, they finally got me. I'm going to jail." When I know that like that's not even how it works. Nobody goes to jail from like messing up on their tax returns. You really have to try hard in order to go to prison for tax fraud. So when you read a letter, read through it, like get a little glass of something if you need to, read through it and reply in a timely manner. A lot of my clients get in trouble because they ignore something that's important, and then by the time that passes, a lot of letters from tax bodies will have like a little thing that says like, if you do not reply by this time, you are basically admitting guilt. By the way, my cat's just going to meow at me a lot. It's just a thing that's going to happen. So if you don't reply within like 30 days, then you are admitting or you are acknowledging that this thing is true. So many times when I see letters from my clients, the IRS or the Franchise Tax Board or the City of Los Angeles has made a mistake. And all I have to do is write a quick letter that says, you are wrong. And then they're like, oops, we made a mistake. And then the situation is solved. But if you ignore that letter, then they're going to send you a bill, which you ignore because you're stressed, and they send a follow-up bill, which you ignore because you're stressed, and then they send out a follow-up bill, and then they send you an intent to levy, or they send the bill that you owe to collections, right? And then that affects your credit score. So many people I see dealing with these negative consequences when they were in the right. So don't be afraid of the IRS or the Franchise Tax Board or whoever. If you receive something, open it up. If it seems stressful, reach out to somebody, because if it's a stressful thing, it needs to be dealt with eventually. And if it's a not stressful thing, then solve it, and then you don't have to stress about it anymore. I know it's counterintuitive. I relate to it because I still will freak out, but try to be as timely as possible. Those are my 5 tips where if you just follow those things, you'll be mostly okay. And now we can get into some of the weird intricacies of taxes. So this year is super exciting because of all the various tax changes that have happened. So the deadlines have shifted just a little bitty bit. So if you might remember, the tax deadline is usually on 4/15, but that was pushed back. So it was pushed back a month, which should be May 15th, but because that falls on a weekend, you have until Monday, May 17th to file your individual tax returns. However, if you have an S Corp, then you should have already filed your returns by 3/15. And if you have a corporation, then you should have filed by 4/15. So only individual returns got that extension. And then obviously you can still file for an additional extension, which will give you until October to file your returns if you need that additional time. But remember, with extensions, you always need to pay what you owe, otherwise you'll still continue to accrue penalties and interest on the balance. That's not the case for the 5/17 deadline, but if you push to October, then make sure that you have estimated what you owe so you're not dealing with additional penalties and interest. You can tell that I'm excited because of these bags under my eyes that are forming from staying up late reading these tax changes. Literally half an hour before this, Renee was like, "Oh, did you hear that the Golden State stimulus passed?" I was like, "No, I haven't, because I've been buried doing tax returns." So now I'm like, "Oh, okay, gotta read the article, Franchise Tax Board, okay, Gavin Newsom signed it, blah, 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 blah." So look forward to lots of fun laughs during this tax lecture, because if I can't make it fun, then it's going to be boring for me, and it's going to be boring for you. So 2020 has a lot of really fun and exciting things, but also some really annoying things. So, and unfortunately, it's much more stuff that is annoying than stuff that is fun. Again, I'm oftentimes the bearer of bad news for my lovely, wonderful clients who have been with me year after year. So you might remember from 2020, a year that felt like 3 years, this thing called the EIDL loan or the PPP loan. So the EIDL loan, specifically the EIDL advance, was an amount of money that you could receive based on the number of employees. And then also after you receive that amount, you could apply for a loan. And then that loan is just like any other loan. It has to be repaid over a specific amount of time. Now, if you receive that EIDL advance and nothing else, that amount is tax-free, according to the IRS. California is like, you think you're not going to pay taxes on that free money that you got? So when you file your California tax returns, you will actually have to file what is called a Schedule CA, where any amount that you received as an EIDL advance, you have to report as income. So if you are working with a tax person, make sure that you report the EIDL amount and the PPP amounts. The PPP loan, very similar. Basically, it is a loan that allows you to continue paying people. And for a lot of people, we are the only person that is being paid by us. So basically, people got the PPP loan in order to be able to continue to pay themselves, even though they weren't making any money. If you are self-employed, you're very lucky because you weren't paying payroll. So if you're self-employed or you're a single member LLC, this probably doesn't apply to you. It shouldn't apply to you. But for the IRS, and this took a very long time to verify, you do not claim the PPP loan as income, and also the expenses that you deduct with the PPP loan are deductible. Previously, you had to remove the PPP loan as like it wasn't taxed as income, but any expenses that you paid for with the PPP loan could not be deducted. So it was a really fun, weird thing where you had to keep track of what payroll was paid by the PPP loan and then take it out for the purpose of filing taxes. The IRS got rid of that because they were like, I don't know, they just felt like being nice, I suppose. California is like, look, Daddy Newsom needs a new BMW, so we're not going to give you free money. So any expenses that were paid by that PPP loan are not deductible. Although it's very weird if you are self-employed or a single member LLC, because if you receive that money and you pay yourself, meaning that money goes from the business to you, then any money that you spend as the individual, not the business, doesn't count because it's not deductible anyway. It's really only for people who are S Corps and C Corps, or if you were a single member LLC or sole proprietorship, and you paid for like rent or specific utilities, or you had other people on payroll. So that is kind of like a weird thing where if you are a person who received the EIDL and PPP for California, you need to be aware of some of those weird intricacies. And so just be aware of that. The one that is really fun for everybody is unemployment insurance. Some people, like the numbers that I saw in unemployment this year were wild because some people were making $20,000, $30,000 in unemployment. Now, a lot of people did not elect to have taxes taken out of their unemployment. So you receive $20,000, $30,000 that now you have to pay taxes on. A lot of people were like, I don't want to be stuck with a big tax bill at the end of the year, so I'm going to elect to have that 10% taken out of my taxes. But, hold for dramatic pause, 1, 2, 3. But what ended up happening for a lot of people was California only took 10% out of the base amount, not that extra $300 or $600 that people got per period. So a lot of people were like, I want taxes to be taken out so I don't have to worry about it. But they would make $30,000 and have $1,000 taken out. And still, that's about $2,000 short of what you would probably need because they didn't take taxes out of that extra amount that people received because of the pandemic. So if you received unemployment insurance, and a lot of you maybe already dealt with this because you filed your taxes, but if you received it, then know that you're probably, even if you elected to have taxes taken out, you're probably going to see a pretty big tax bill. So even more so than normal, I get to deliver lots of really terrible news to my clients who I love more than my own children, which is helpful because I don't have children of my own. So it's easier to love somebody more than zero. So that is kind of annoying. The nice thing is that your unemployment insurance isn't taxed at the state level. It's only taxed at the federal level. So you're only paying taxes when it comes to your IRS tax. So a lot of people are waiting to file their taxes because there have been rumors that the IRS is going to pass a law saying that they're going to forgive your, like, that part of the unemployment. At this point, it's very unlikely. Hey, it's me, Jeff. I'm back because there are tax law updates. Since we recorded our session, I feel like years ago, the tax law that I did not think was going to pass ended up passing, which is good for all of the citizens who those tax laws benefit. So I am doing a really quick update on the law so that you have the most up-to-date information. So, two big changes to the tax law involve unemployment insurance and the advanced premium tax credit repayment. So, if you made less than $150,000, then that means that you can exclude $10,200 of the unemployment income that you received. So the adjustments will be made by any software that you're doing, so I don't necessarily need to go through the intricacies of doing so, but you just report it and then it will take that deduction under other income. $10,200 knocked right off. So if you've already filed and you didn't have that deduction, then the IRS is saying do not do anything. They will automatically reprocess those payments for you. The other one that is similar is the advanced premium tax credit. So if you have a plan through Covered California or the healthcare marketplace, then you might be familiar with the fact that based on your income, they will reduce the amount of premium payment that you have to pay per month. Right? So if you make more income or less income than you reported, then you will either get a larger tax refund because they will refund the amount that you should have received, or you'll have to pay some of that back, which will lower your refund or cause you to have to owe money. So, if you are in a situation where you would have had to pay the premium tax credit repayment, then you don't have to for 2020 and 2021. So if you have not filed, then just know that that penalty that you would have had to pay, that repayment, is not going to affect you this year. If you've already filed, same as with UI, the IRS has not given any guidance on how they're going to handle that, but they have asked that you not file an amended return yet. So if those two changes apply to you, then make sure that you hold if you've already filed, and the IRS will give us more information. But for UI, you will get refunded, or if you're about to file now, know that those are things that you can benefit from. There may be some very weird cases where you'll still need to file an amended return. So for example, let's just say that the UI forgiveness reduces your income and makes you eligible for the earned income tax credit. That might mean that you have to file an amended return in order to be able to claim the earned income tax credit. So just be aware that there might be some cases where you might need to double check to make sure that you're eligible. The other thing with the earned income tax credit, they've increased the cap, so it is much easier to earn the earned income tax credit for low income tax filers. So even though you might not normally have been eligible for the earned income tax credit, with the forgiveness of UI and this higher cap, you might now be eligible. So a lot of tax software is updating people if they filed and now are eligible for these things. Check with your tax preparer, but be patient with them because they're getting hundreds of these questions from everybody. So, but just know that there are these new options. So a few other things that might apply to you, or maybe you just want to know about it because you're a nerd and you're like, I love tax facts. So the third stimulus check, $1,400 going out to most households. The cap for single filers is $75,000. For married filers, it's $150,000. And if you are head of household, it is $112,500. That's when the phase out starts to begin. So another fun thing that you might not have known about is the extension of the additional boon to unemployment. So that $300 a month. I remember back in the good old days when it was $600. Those sweet, sweet days. But also, if you're the type of person who might have a student loan or two, if those are forgiven, you do not have to pay taxes on the forgiven amount. It used to be that forgiven debt was taxable. It still is for everything that's not a student loan. So if you experience a student loan forgiveness between now and January 1st, 2026, then you won't have to pay tax on the forgiven amount, which is nice. So for people who have parents, for people who have children, but also, maybe it was a time travel thing and your parents are children now. So you gotta be careful with time travel. But if you have children, then the child tax credit has been expanded, and also there will be additional payments made in addition to the normal amount that you would get when you file your taxes. I believe that those payments are going to be starting in July, so make sure that all of your tax information is up to date so that you can get those payments if you are eligible for them, especially for people who had a child in like the past year. So maybe when you filed your 2019 tax returns, you didn't have a child, but now you do. Make sure you get those credits. So the stimulus checks are not taxable. They are a credit against your 2020 taxes, which you are filing now. So if you did not receive them and your income is below the requirements, there are different income requirements for both of those. I don't have them memorized, but if your income is below that, then you would qualify for them, and then it would just be added to your refund. Or if you owe money, then it's going to lower the amount of money that you owe. So if you didn't get either of them during the year and you still qualify for them, so you're not making like $200,000 a year, or you didn't make that like last year, so you know, qualify that case. So let's just say you made $50,000, you owe $2,000 in taxes, but now you get to add that to what you owe. So now you only owe $200. Wow. So if you missed out on it, if you didn't receive it for some reason, your tax person is going to ask you that. And I know a lot of people receive that $600 in 2021. Even though you received it in 2021, it still applies to your 2020 tax returns. So like sometimes people were like, I got it in 2021, it doesn't matter. I'm like, it does matter because it's a credit on your 2020 tax returns that you received in 21. It's dumb. It's weird. We love it. So there are a lot of like proposed tax changes that just haven't been put into law, even though this new tax law has been voted on and approved by the House of Representatives. It still has to go to the Senate, and then it has to go back to the House of Representatives to be verified or signed again, because the Senate's probably going to change the law. So my general advice is don't make plans based off of something that isn't in the law yet, because as we've seen last year, everything is changing constantly. So, we just don't know what things are going to look like. So we talked about the EIDL, we talked about the PPP, we talked about UI, we talked about the stimulus checks. So a lot of us worked from home this year, as you can see from the fact that I am very obviously home, my cool painting in the background. So unfortunately, the same rules that always apply for home offices apply now. So if you have a W-2 job and you had to spend extra money in order to work from home, more than likely you're not going to be able to deduct those expenses. So back before the Tax Cuts and Jobs Act of 2018 was passed, you used to be able to itemize on your federal returns unreimbursed employee expenses. These are expenses related to your W-2 work that have not been reimbursed by your employee. You would itemize them. If they exceeded your standard deduction, you can take them as an expense on your returns. Unfortunately, those were removed from your federal returns, so you can't even try to deduct them for your IRS returns. You can still try to itemize them for the purpose of your state returns, but a lot of people aren't going to meet that threshold, so it's not going to be a deductible expense. So if you have a home office, or if you have been working from home, more than likely you're not going to be able to take that deduction. Also, you have to be careful of like trying to deduct things that are costs that you're already spending. So for example, if you have internet and now you're using your internet from home, it's not really an unreimbursed employee expense because you were spending that money anyway, right? But if you like upgraded your internet, or if you paid for, the Premiere Zoom so that you didn't have to be limited in time, or those types of things, those would be additional expenses. So sometimes a little weird trying to sort that out, but it is something that, if it's a substantial amount that you can look at, but it's only going to affect your California return. And also, if you're like in a lower income tax bracket, the amount of savings that it provides might not even be worth the time in trying to deduct them. So that's a bit of bad news. Again, it's just bad news for me. I very rarely say like things that are like fun and uplifting. So if you are a Schedule C and you have a home office, meaning that you have a dedicated space that is exclusively used for business. So, for example, this is like, as soon as this is done, I'm going to like start watching a movie. I'm watching all my SAG screeners right now. So, Promising Young Woman, right? So that's, kind of work related, but I'm technically watching it for pleasure. So I'm, doing something fun at my workspace. This space isn't exclusively being used for work. So as a result, I cannot take this desk as a home office. Now, if I use this space only for work and I never did anything else in this specific space, then I could look at possible home office deduction. I don't. So, real quick, because Renee was nice enough to remind me of this, we have now in law the Golden State Stimulus. So, most of us, I'm assuming, are Social Security number filers. If you have an I-10, then there are different laws that apply to you. But essentially, people who qualify for the earned income tax credit, people making less than $30,000 a year who will file their 2020 tax returns. So that is the ones that you're filing this year right now. If you file them by October 15th of this year, you will get automatically either a $600, $1,200, and that will be automatically sent to you. You don't have to do anything to claim it aside from filing your tax return. So depending on how you qualify, you could get either a $600 or $1,200 based off of your income and your marital status and all that fun stuff. So that's just an automatic thing. So just make sure you file your tax returns in a timely manner. Congrats to all of those who qualify. When you go to sleep at night, just say a little prayer for Mr. Newsom up there in Sacramento. So one question that I always get that's hard to kind of answer is, do I need a tax preparer? And it's a similar question to like, do I need a mechanic for my car? Obviously, like, almost anyone could learn how to like change their oil. And a lot of the clients that I work with are not the level of just changing their oil. So like, if you are a W-2 employee and that's all you do, you don't have stocks, you don't, you're not doing anything weird, then you can probably just get away with doing TurboTax. But the more complicated your returns are, the more I recommend at least like having somebody to check in with. Different people are going to have different rules about, like, for me, I'm like, if I'm going to answer all these questions that you have, I might as well just do the return for you. But like some people might just like charge you a flat fee for a consultation or like a review of your documents before you file, blah 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 blah. So the more complicated things are, the more helpful it is to probably have somebody to at least check with, or sometimes it just makes more sense to pay somebody to do it. I sometimes have clients who will like reach out to me and they'll say like, yeah, I spent like 5 hours like researching this thing. I'm like, I could have answered that question in 5 minutes and I wouldn't have charged you for it. Why didn't you just call me? You pay me. So be aware of like the value of your own time and think about like there's bounds to everything, but that goes back to the idea of like knowing yourself, right? If you really are a big nerd and you love reading tax law like I do, then go ahead and do it and like, learn about the intricacies of depreciating a cow. I'm going to give you a hint. It's going to depend on if you're using it for milk or for beef or as livestock. Oh, so it's always a hard question for me to ask because I never know anybody's like tolerance for frustration. So Let's just talk about some of these key things. What I did was I read through the description of the event to make sure that I hit on all the things in the event description so that none of you would write nasty tweets about me. I'm too young to get canceled. I'm a man in my 30s. So, hopefully I answer all of your questions. So I'm going to go through everything that's listed. So just so you know what we're going to cover, we're going to cover record keeping. We're going to cover the 1040, technically the 540 as well, which are your income tax returns for federal and state. We're going to cover the different forms that you'll probably see, the most basic ones, 1099s and W-2s. We're going to talk a little bit more about the different types of deductions and expenses that you can take. We'll talk about the forms that you'll use in order to report your business income, the Schedule C, the Schedule SE for the self-employment tax, as well as the Schedule K1. We'll talk real quickly about hobby losses, and then I know everybody loves to ask about LLCs and S Corps, so of course I'll save a little bit of time for LLCs, C Corps, and S Corps because I care. So if you could say some real mean things about me on Twitter, but the one thing that you can't say is that I don't care, because I do. You can tell that I do because I said it a whole bunch. So let's talk record keeping. So weird thing about the IRS is they don't specifically say how you should keep your records. They just need to be done in a way where it is very clear what the sources of information are. There are some very specific things. These have to do with meal expenses and mileage. So when it comes to record keeping, the idea is just imagine you're being audited. Uh-oh. And then the big, mean IRS agent is like, it looks like you took $2,000 in advertising expenses. Prove it! That's exactly how an audit goes. It's like any interrogation scene that you see in a crime movie. So I just watched the little thing. So there's just a lot of slamming on desks and throwing stuff and saying, you don't have the proof. So just imagine if somebody was like, well, I just need to see how you got to this number. Would you be able to prove that, right? So sometimes people might just have a whole bunch of folders, right? And some people print out every online transaction and they put it in a folder. Or you might have Dropbox or a Google Drive thing, or a section of your email that has your receipts. But just imagine if somebody were to ask, how long would it take for you to be able to prove that that expense occurred, right? So whatever way is easiest for you to be able to substantiate something that might be asked, that is the way to go. Right? So if you're the type of person, and I don't recommend this, but there are a lot of people who do this, who just go through their bank statements at the end of the year and highlight everything and then add everything up, then just make sure that you don't toss those. Make sure that you hold on to those things, right? And you just have them in a folder. You keep them for 3 years. And then anybody has any questions about it, you can point to the specific things and say, in January and March and blah, 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 that's how I got my advertising or my whatever expense that you might have. The two tricky ones are meal expenses. You usually don't need to keep receipts unless it's more than $75. But there should be a clear denotation of this is who I was meeting with, why I was meeting with them, right? So you really don't want to mess with meal expenses. I'm going to ruin this for you now. If you put maybe you're meeting with 5 people and the bill's $250 and you put $250 on your tax returns, but everyone reimbursed you and it was only $50 that you paid, then you also have to claim that income. That's not, rewards points are a thing, but some people are like, oh yeah, I just paid for it, but then everybody reimbursement. It's like, you have to claim the reimbursement because that's income, right? So, and then make sure you have that receipt and make sure you detail that. Meal expenses are super easy to audit just because most people don't keep good records for those. So definitely be careful. In order for a meal to qualify as a deduction, there has to be a clear business purpose. So I have a lot of friends who are in the industry. If we are going to get drinks, remember when you used to go get drinks with people? If we are separately ordering Grubhub drinks and just talking about how stressed we are about like our SAG screeners taking too long to arrive. That's not a business meal. A business meal is I'm trying to do some specific business thing with a person. So if I'm courting a manager and I take them out to lunch, then I can deduct it. If I'm planning out my career with my manager, I can deduct it. If my manager and I are best friends and we're just hanging out, but we're just hanging out, but we just happen to bring up business, it's not retroactively a business meal. So just avoid trying to get away with those, because that's, if I were going to try and audit somebody, that would be the first thing that I just look at on a return. It's like $3,000 in meals and expenses. Oh, open it up. So the other thing is mileage. The IRS specifically says that if you're taking mileage deductions, then you have to have a mileage log. So if, a lot of my clients don't have a mileage log, and then they'll say like, I probably drove like 5,000 miles. And with that, I have to specifically like go, like we have to go through and say, okay, where are the places that you were going? What was the mileage? And then we have to do the math for that. And that's not even the right way of doing it, because they're supposed to be what's called contemporaneous. So that means that like you need to be filling in that mileage log as you're doing it. So there is a chance that the IRS could just be like, but was this contemporaneous? And I'd be like, no, it wasn't contemporaneous, because I'm reporting under penalty of perjury and I do not want to perjure myself. And they'd be like, ooh, I don't think we can deduct this. And then that's when I fight them on it. I'm like, yeah, but it was incurred and blah, 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 blah. But mileage is also the big one. So there are apps that will keep track of your mileage for you as you drive. I recommend just installing that app. Some of them cost like $3, but that $3 that you spend, one, is deductible, and two, is going to save you a lot of time at the end of the year trying to like go back and try and figure out things, because you'll have a contemporaneous log. So those are the big ones that you want to have good records on. Another weird one is research. So as you might know, as a creative person, you can deduct a lot of your research expenses. So, for example, let's say I'm writing a thriller in the vein of like the Taken films. I cannot access them for free, so I pay, $30 to rent all of the Taken films. And so I'm specifically watching them not for entertainment, but for research. I can deduct that as a business expense as a writer, right? Or maybe you have an audition coming up and maybe it's for a TV show that you haven't seen before. So you get on Amazon and then you rent the entire show so you can watch it a few episodes and get an idea of the tone of the show and how that character might fit in. Deductible as a performer, right? Now, sometimes people have something like Netflix, which could be a business expense, could be a personal expense. When it's weird like that, then you really want to have very clear records. The IRS suggests that you are able to show notes that you've taken. I think, depending on the situation, you might not need to have a specific notebook, but if you are trying to keep track of stuff, that would not hurt. But you need to be able to prove that this thing that is entertaining has a business component to it, because it would be very easy for them to say, no, there's no clear distinction between the business and personal aspect to it. We're going to disallow this deduction. So it is deductible. You just need to be able to substantiate that. So the key to record keeping is just making sure that you can substantiate anything that you claim on your returns. So let me just talk about these general forms that you might see. So the most basic form that you see, my hand is now a 1040, is the form 1040. This reports all of your income, all of the adjustments to income, the taxes that you owe, the credits that you're eligible for, the taxes that have been taken out of paychecks during the year, or the taxes that you have paid during the year, and then they consolidate that into a tax return. So all of your income and expenses and deductions will help you compute what your taxable income is. Your taxable income, so let's just say it's like $30,000. So 10% of that is $3,000. So that means that you owe $3,000 in taxes. Uh-oh. But you had a W-2 job and they took out $4,000 from your paychecks during the year. So those withholdings go towards the amount that you owe. And that is why you would get a $1,000 refund. So a lot of people focus on the refund because it's a big number and we always see it, right? But the only reason why you get a refund in most cases is because you overpaid on your taxes, those withholdings during the year. So my dad always says you're just giving the IRS an interest-free loan, which you essentially are, right? If you get a $5,000 refund during the year and you were living paycheck to paycheck during the year, then that means that like you could have had 5,000 divided by 10 is 500, 12 is like 450, something like that. Quick math, don't check it. You would have had 450 extra dollars a month, right? You would have gotten a small refund, but you wouldn't have needed to depend on that refund. And then if you owe money, that just means that you had more money available during the year. But a lot of us might not notice that extra money because, if it's 50 extra dollars per paycheck, that's 100. If you're being paid bi-weekly, that's $100 a month. You might not notice that. But then when you owe $1,200 at the end of the year, when you file your taxes, you do notice that. So what the Form 1040 is doing is it's just taking everything that you have, your employment income, interest and dividends, capital gains or losses from stocks, if you have alimony, if you have unemployment compensation, if you have income from like a Schedule K1, so you're part of a partnership, something like that, any deductions, maybe contribute to an IRA, maybe you're an educator and you take that $250 deduction for K through 12 educator expenses. All those things add up together and allow you to determine your adjusted gross income. Then you can take the standard deduction, which lowers your income even more. And that standard deduction is about $12,000 for individuals, 24 for married couples, and I think 18-ish for a head of household. So that lowers your income even further, and that tells you what you are taxed on. And then you compute that tax, and then you compare that to what you paid during the year, and that will tell you what your refund is or what the balance owed is. One thing that a lot of people don't know is when you find out the balance that is owed, you don't actually have to pay it all at once. There are two things. One is an installment agreement, which is just a payment plan. Interest does accrue over time, but it's better than not filing because you owe money and then just waiting because then additional penalties are going to accrue, right? So if you owe $1,200 and you can't pay it all at once, but you can do $200 a month for 6 months, you'll pay a little bit in interest, but it will get paid and it's not going to get worse over time. Offers in compromise are a pretty complicated process. Essentially, you can tell the IRS, hey, I don't know how, but I owe $30,000. I cannot reasonably pay you $30,000. Can we settle? And it is pretty crazy how reasonable the settlements can be. So if you're ever in a situation where even with a payment plan, you cannot pay the money that is owed, then the offer in compromise is something to consider. The main forms that you get during the year, especially as artists, are Form 1099s. They used to all be Form 1099 MISCs for miscellaneous incomes. This reports royalties, rents, and non-employee compensation, also sometimes other income. But now we have a separate 1099, the 1099 NEC for non-employee compensation. Why did they split it? I don't know. They just like making life hard, I guess. So those all get reported on your Schedule C in most cases, and that's part of your business income. Anything on a W-2 is you are an employee of this company. So as mentioned before, you have to split those deductions. It's very hard to deduct things against a W-2. For most of my clients, I'm like, it's not even worth like trying to calculate it, because if it's like, oh, I spent like $250, I just know based off of other stuff that I see on the return that it's not going to make a difference. But with the 1099s, every dollar counts. So a lot of people confuse itemized deductions with business expenses. So as you might be familiar, you can take the standard deduction every year, or if you have a lot of expenses that exceed that, then you can take itemized deductions. These are personal expenses. Okay, so itemized deductions include things like medical expenses, which most people don't get to deduct because your expenses have to exceed 7.5% of your income before you add them to your itemized deductions. So let's just say I made $100,000 during the year. I have to spend more than $7,500 in medical expenses in order to be able to deduct them. If I made $50,000, I think that's $3,750. So most people aren't spending, more than $4,000 a year. But if you are, then you could add them to your list of itemized deductions. The big one for a lot of people is mortgage interest and property tax. Those two add up, and then also state taxes that you might pay. So the what are called SALT taxes, state and local taxes, including property tax, have a $10,000 limit, so you cannot deduct more than $10,000. That is a new thing from the Tax Cuts and Jobs Act. But let's just say you had $10,000 of that and $3,000 of mortgage interest during the year, and maybe you had, $2,000 of charitable deductions. That's $15,000 if you're a single person. That exceeds the standard deduction, so you can itemize your deduction. So instead of taking that $12,000-ish, you can take that $15,000, which gives you an extra $3,000 in expenses. So those are the four main things: medical expenses, charitable deductions, state and local taxes, mortgage interest. So you might notice that I didn't mention things like advertising or equipment for my business or classes and workshops. That's because those are business expenses. If you have a business, then there's no standard deduction for businesses, right? With a business, whatever you paid is whatever you deduct. So you can't just be like, I don't know, I don't feel like looking through this. Let's just say $5,000. So you actually have to add up everything. But the great thing about that is that every dollar actually makes a difference. So when my clients are having a harder time sorting through their expenses, I'm like, start with the big things, right? Because if I can find 5 acting classes, or I can find 5 parking meters that I paid for, those 5 acting classes are really going to add up, right? So if you don't have really good records, at the very least, try to find the most substantial expenses that you have. So that's the big difference between those two. Business expenses, it's dollar for dollar. Most people, let me say, I'm dealing with like 300 something returns this year. And out of the ones that I've done so far, I think I've looked at like maybe 100 right now, and like 3 of them have itemized. It's very rare that in my clients, and they range in variety of like income tax brackets, have to itemize. So those are those.
I work full-time at a school, but I have a taiko drumming hobby, and this year I began teaching it. I made $700, including deductions. My tax preparer put it on a Schedule C. I file jointly with my wife, who is an artist with 1099 income. Is this hobby worth it?
Any income that you receive, you're going to have to pay taxes on it. This is actually a good transition because we're going to talk about hobby losses. So essentially, if something is a hobby, then you are limited in the amount of loss that you can deduct against it. You can't have a net negative for that hobby. If it's a business, then you can't, right? The difference between a hobby and a business, the IRS breaks this down pretty intensely, but essentially, are you trying to generate a profit, right? So like maybe let's just say I play the violin sometimes for fun, and then my friend's like, oh, I'll pay like $200 to play the violin for my kid's party. Weird request, but that's not a business. So I don't get to like depreciate my, Stradivarius, which is worth $100,000 over, the next 7 years, and take a loss on that business. But if it were a business and I were spending a lot of time trying to book gigs as a musician, so you always have to claim it. So that's not really the question. The question might be, whenever you have expenses that you can claim, it's always worth it to look at those expenses. But I would say look at that with your tax preparer to see what is worth it. Weird thing about this year, and it's a little controversial because there hasn't been an official ruling about it. If you are having a virtual meeting and you buy food for it, for me, it feels like cheating. but technically it's a business meal. So if you like buy coffee in order to have a virtual coffee or like a virtual meal with somebody, it's technically deductible. So that's one of the ones where like it feels weird, but like there's nothing in like the law that would say that it's not, because it's just specifically like if you're buying food for the purpose of like a business transaction, it's deductible in your taxes. So yeah, that is a weird one that actually is allowable, and I've been in a lot of conversations with other tax preparers and we're just like, it feels wrong, but we think it's deductible. So commuting miles are not deductible. So if you are, so like let's just say I never work from home and I have an office and that office is where I do my business, I cannot deduct my miles going from home to the office. If I go from the office to another location, so let's say I need to pick up paper from Office Depot and bring it back to my office, those miles that I drove to Office Depot are deductible. If I go back from my office to home, not deductible. But if I work from home and my home is one of my main working spaces, and then I also have like a separate office, then my miles from home to the office are no longer commuting miles, they are business miles, because I'm going from one place of business to another place of business. So things like that, let's say you're doing a play, maybe you're directing, and you do a lot of work from home, but then you also drive to the theater to do director things, then those miles would be business miles. Research and professional development seem similar, but I separate them. So classes are things that you do in order to improve a specific skill. Research is something that you pay for in order to gain specific knowledge. Usually when you're researching, you're the person driving the knowledge. So I'm watching a show on Netflix because I'm writing a spec script. Research. I'm taking a class from the showrunner of that Netflix show to learn about their creative process. Classes, workshops, professional development. That's one way of making it a little bit easier for you. Honestly, it doesn't matter if you lump it all together, but those would all be deductible expenses.
What about income I receive from a fiscal sponsor?
Even if that money comes from a 501c3, when you receive it, it is taxable to you as income. But you also can report money that is paid out to other people. So let's say, like, for example, I have a client who does music recording. He gets paid 1099 by, whoever is paying him to do the live music recording thing. But then he also pays musicians out of that. He makes maybe $5,000. He pays 4 people $1,000. So $5,000 of income, 4,000 of expenses. He gets taxed on the net of $1,000. So that's why it's important to keep track of the expenses that you have, because that reduces the amount of income that you're being taxed on. Student loan interest is deductible for most people. That's an adjustment to income. I unfortunately don't have a lot of time to go into all those adjustments, but it's not a business expense. It's not an itemized expense. It's what's called an adjustment to income. Those are also things like contributions to a traditional IRA. A lot of questions about deductions. So let me just go through some of the major ones that you'll see. So I wish I had like an Animaniac style song for these. I don't. So we have mileage, advertising, so things like IMDb Pro, having a website, printing headshots, business cards, other promotional material, casting sites or any of those types of work sites, Actors Access, LA Casting, Casting Frontier, Backstage, commissions. So these are a little bit weird because sometimes our commissions are based off of W-2 work that we do. The way that I see it is that commissions are not an unreimbursed employee expense. They are a business expense because there's no expectation that your employer would ever be expected to reimburse you for your commissions, nor are they a required expense of doing the job. You have made a business arrangement with your agent to whatever work they get for you, you pay them 10% or whatever percent of that. That's how I see it. That is a very controversial thing, so just know that is controversial. A lot of these things are unfortunately controversial. The thing that I look at for guidance, the IRS has a 115-page audit guide for people in the entertainment industry, and I'm probably one of 0 people else in the world who have read that, and that's where I base my information off of. But the difficult thing with a lot of these things is, even if you take a deduction that you feel you are eligible for, the IRS still has the right to disallow it, but you also have the right to protest that and appeal that. So we have fun. Certain dues, especially like if you're a freelance performer and you're paying like a coach for your improv or sketch team, parking for the, whatever freelance stuff you're doing, business meals for a specific business purpose, or travel meals. So if you are traveling for work, let's say, I made a whole bunch of paintings and then I decide to fly to New York for a gallery, all my meals while I'm in New York are deductible. In addition, all my travel expenses are deductible. So we talked about research. You can also look at a proportionate cost of your cell phone. So if you are, using, I don't know, let's say $100 a month in cell phone bills, and you know that like 70% of your cell phone use is related to business, you can take a $70 a month cell phone deduction. The question that I know you're going to ask me is, how do I know that it's 70%? Ha! It's impossible. You just do your best to calculate that, because like, how do you calculate like how much of your internet use? And like when we just use cell phones for calling, it was easy. Now I guess you look at like the screen time on your phone and it's like, well, how much of my Facebook time was business? You just do a reasonable estimate for that one, is what I say. Classes and workshops, travel, equipment, supplies. Just so you know, clothing is not deductible if it's clothing that you could wear as a normal person. So even though this might be the only shirt that I wear for this class that I teach, this is my business class shirt, I cannot deduct it because I could wear it as a non-business class shirt. If I was doing this in an inflatable T-Rex costume, I could deduct it. So office expenses and software, repairs and maintenance on business equipment, rent and lease for rehearsal, performance, artistic spaces, people that you pay, whether they're contractors or employees, local business taxes or sales taxes, bank fees if you have a separate bank account for your business, lawyers and accountants, although you cannot deduct your personal tax return costs on your business returns. There are some weird exceptions for being able to deduct health insurance on your personal tax return, but also like liability insurance, workers' comp, things like that, and gifts. You can deduct $25 in gifts per person per year. So if you wanted to Venmo me $25 right now, no, I'm just kidding, but you could deduct it, but only $25 worth of it. So if you receive a per diem for like a meal, then you report that per diem as income and it should be listed on your 1099, but then you deduct the per diem. So you get $1,000 in a per diem, but then you deduct $1,000 in that per diem. So let me just real quick talk about Schedule Cs and then LLCs, and then I'll try to get to as many questions as we can. The Schedule C is the form that you use in order to file your business tax returns if you're a sole proprietorship, or if you're an LLC and you're the only member. Whatever income you receive is going to be subject to self-employment tax. So a lot of self-employed people end up with really big tax bills because not only are you paying income tax that hasn't been taken out of your paycheck during the year, 15% of your net income is going to be taken out and paid towards your Social Security and Medicare. So that's at minimum 25% that you are paying in tax. So it's important when you're doing your tax planning to be aware that you might go, I only made $10,000 net. Well, 25% of that is $2,500, right? So be aware of that as a possibility, but that is all going to be calculated either by your tax professional or whatever services you're using to do your taxes. But that is one of the key things when you're looking at like reducing your tax burden as a freelancer, because if you lower that income, that net income from your business, then you're going to be able to pay less in self-employment tax and less in income taxes. So that's something to be aware of. Real quick, this is usually like a 20 to 30-minute call that I do with clients. Just having an LLC saves you nothing in taxes. In California, you're also going to have to pay a minimum tax of $800 in order to just have an LLC every year. Having an LLC or a corporation does one good thing for you where it separates your business assets from your personal assets. So in the case of a lawsuit, and this is where you would want to consult with a lawyer to talk about the legal ramifications of having an LLC or an S Corp. I cannot give you legal advice concerning this. I'm only giving you my personal opinions because I'm not a lawyer. But it can hypothetically provide some asset protection because if they sue your company, you are not being sued. But a lot of people actually mess this up because they will use their company account as a personal account and pay for a lot of personal expenses out of their business account. And so in most cases, it doesn't make sense to form an LLC or a corporation unless you're really worried about liability. But then in that case, you might also just want to consider liability insurance. But again, talk to a lawyer. So you might have heard of the illustrious S Corp. Now, what the S Corp does is it treats your income in two different ways. Part of it is you pay yourself as an employee, so you're still paying that self-employment tax, you're still paying income tax, but then you treat some of your income as basically a dividend. Dividends you don't pay self-employment taxes on, so you're saving 15%-ish on your taxes. But you're paying $800 to the state to have an S Corp. And then there's also 1.45% tax on S Corp profits. So for most people, it doesn't make sense to form an S Corp. Honestly, and you might have heard this number before, once you're making $100,000 in profit, so this is after expenses, that's when it kind of makes sense to look at an S Corp for tax planning purposes. So don't rush into it. Don't listen to people who are like, oh yeah, I saved all this money on taxes. You really have to look at the numbers, and it's going to depend on a person by person basis. And you're just going to, because also you have to pay an accountant unless you're running payroll yourself to manage all the intricacies of doing that. You have to file a separate corporate tax return. Some people are going to charge like $800 to $2,000 to file that. So you need to be saving more money than you're actually spending.
I am an arts teacher in a school district but have also started working as an independent contractor. So, if you have both types of income, how does that impact deductions?
So this is a really good question. Essentially, if you actually, a lot of artists fall into this where you have W-2 income and you have 1099 income, and then you have expenses that sometimes are related to both and sometimes related to one or the other. The easiest and clearest way to do it, and the way that I recommend doing it, is just making sure that you keep good records so that you know what things are related to your W-2 work and what things are related to your 1099 work, right? If you have something, so like maybe you buy art supplies that you bring to your classroom W-2, but you also use for your freelance work, one way that you might want to do it is just like a 50-50 split. I think that's fair. I think that might hold up in an audit where it's just like, yeah, like there's no easy way to determine what is one or the other. The way that the IRS might prefer that you do it is you allot it by proportion of income. So let's say you make $90,000 on your W-2, $10,000, 1099, you would take 90% of your art supplies and allot it to your W-2, 10% to 1099. So as the easiest thing to do is just keep things separate. And if you can't, which a lot of us have a hard time doing, then you're going to have to figure out the easiest way to split those things. But yeah, it does make an impact on the deductions.
Since an art studio counts as a dedicated workspace, is studio rent a deduction?
So when it comes to like taking like an art studio as a dedicated workspace, it's going to depend on like how that, so like let's just, the easiest way to do it is you're a 1099 person or you're filing a Schedule C, you have a separate place that is an art studio. You pay rent to that separate place. You don't live in it. You don't do anything personal in it. It is just fully used as an art studio, fully deductible, right? You put on your 1099, mwah. If, let's say, I have a 2-bedroom apartment, then I have to figure out, and so 1 bedroom is my art studio, the other bedroom is my bedroom. Then I have to figure out the square footage of that space, and then the total square footage of my entire place. And then I take a percentage of all of my home expenses, rent, utilities, etc. And then I deduct those on my tax returns. On my Schedule C, if you are operating at a loss, that amount is limited, blah, 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 blah. But yeah, the easiest thing is always to have a separate place, because then you don't have to do any weird math with that. So I used to have a tax office. I don't have one now because I'm not meeting with people. So I would deduct that rent separately, because when I was there, I was doing taxes, right? Everything that was there was all business related. So that kind of stuff, is fully deductible. When I work at home, there's nothing that I do at home that I can deduct, unfortunately, because my apartment is small.
Can I deduct my beer as a study during this workshop?
Unfortunately, you cannot deduct alcohol, but you can appreciate it. The secret is to have working meetings while you drink, and then you could buy the expensive stuff as a business expense. But you can't then use that same alcohol for personal use. So you have to separate your business booze from your personal booze. That is both a joke answer and a real answer.
What's the difference between a deduction and an expense?
Technically, they're the same thing, but when we talk about deductions, we're normally talking about the itemized deductions or the standard deduction. When we're talking about expenses, we're usually talking about business expenses. So both of them lower things. It's just a matter of where they are on the tax return. Same thing with epinephrine and adrenaline, same thing, just what part of the body are we talking about? I just taught a biopsych lecture earlier, just in case you're wondering why I just randomly dropped that knowledge. But, you learn things. So it really doesn't matter. People use them interchangeably. I accidentally use them interchangeably. They all do the same thing. Can you deduct business expenses if you were paid personally and not through your business, C and LLC? Technically, yes. It gets more complicated if you have a separate business and it's just dumb accounting thing. So essentially what will happen is I pay something, the business reimburses me and deducts that reimbursement. But on your tax returns, it's just going to show that you deducted for office supplies. So yes, you want to make sure as much as possible that you separate things for that, liability issue, because you want your business to be separate from you. But it does happen. I have clients who will sometimes write checks to me, or they'll misspell. My business is called My Name is Jeff LLC. And so people are who should I write the check out to? And I discovered this recently where I say, oh, you should write it out to, or they ask, who should I write it out to? And I say, my name is Jeff LLC. And then they'll write a check to Jeff LLC, which is hilarious. But the bank doesn't care. It still gets cashed. So as much as you can, just keep things under the business.
How does one go about filing with both the 1099 from a day job and W-9s from performances?
If you have 1099s from work and then you have W-4s from other work, it all goes on the tax return. So all of your W-4s get added up. They get reported on line 7 for your total wages. All your 1099s get added up. They go on your Schedule C. All the expenses that are related to your Schedule C go onto your business return. Everything that is related to your W-2 in most cases doesn't count. So it seems like it's more complicated, but essentially you just add up all your wages, put them together from your W-2s, you add up all your 1099 and cash income, you put them on your Schedule C, and then you break down all of your expenses and report those on your Schedule C.
If I moved states and I used a U-Haul to move a large piece of equipment for my artist business, is the U-Haul deductible? Is the gas deductible? What if it's for mixed use?
You used to be able to deduct moving expenses. You can't do it anymore. If the cost is specifically for your business, then you can deduct it fully if it is partially for business, partially personal, then you have to look at the additional expense of the business aspect of it. So let's just say you're going to get the smallest U-Haul, but all of your art stuff require that you upgrade to the next one. Then I would say the cost of the upgrade is deductible. I wouldn't try to depreciate the gas cost because that's going to be really hard to try and figure out and probably not really worth it. You would just have to figure out the cost that is related to business specifically.
My 1099 income is more hobby income for 2020, but I see this changing drastically for 2021. Does it make sense to meet with a tax preparer after tax day this year, but before tax day next year?
I mean, it's going to depend. Like, if your expenses are pretty straightforward, then you might not need that because I feel like you already know the answer that you'd probably be asking. If your questions are more like, how do I get organized and ready to work with a tax person, maybe you might want to reach out to somebody and like think of, if you want to think, what's the best way that I can maximize my expenses and minimize my tax. Obviously, the earlier the better, because if you wait until February, you can't retroactively change anything from this year that will be last year.
When are the tax preparers past the emotional breakdown phase of tax season?
Technically, I never stopped doing taxes because I was still doing taxes in December. So like I still haven't emotionally broken down from last year because this has been really emotional. So more than likely, like May of this year, all tax preparers at the same time will just like die around the world from exhaustion. But then from our ashes, new tax preparers will be born. Renee, I think that might be our
Yes.
last one.
Yes, I saw that was our last question. And so, Jeff, thank you so, so much for leading yet another great workshop for California Lawyers for the Arts. We're so lucky to have you.
It's a crazy time, so hug your loved ones. If you have a furry animal, give them a kiss on the forehead. If you have a fuzzy or feathered animal, give them a kiss on the forehead if they allow it. Birds sometimes don't like that. So take care, and I hope all these updates helped.